Okay, hi there. Good day. I'm really happy to welcome you guys. Very good to see some familiar faces, clients of FXCC, and I would like to welcome you on today's introduction webinar on risk management. It's a series of webinars that we'll be actually doing on risk management. So this is the introduction part, and this very interesting webinar is brought to you, powered by and sponsored by FXCC, organized by FX Geometry. My name is Kenny Simon, the presenter and the trainer for you today on this webinar. Now, just before we go on further into the topic itself and a couple of things revolving risk management, I would like to read to you a little bit on the risk warning, just the first paragraph, and you could take your time and look at the rest of it at your own pace. So all financial instruments, including forex or currency trading, all have large potential rewards, but they also have large potential risk. You must be aware of the risk and be willing to accept them in order to invest in these markets. Don't trade with money you can't afford to lose. So that's all I'll cover there, and I'll leave it to you on the the rest of it to you to read at your own pace. Okay, let's get into it. And before the what and the rest of the topic, I would like to cover the question of why risk management. Now, in order for us to look into a sort of a successful system by a trader, it usually comprises of these elements. It comprises of money management, of course, that comprises of 30% at least, and then you've got the system development or the strategy itself, which is only about 10%, but a very large part of it would be psychology. Now, both psychology, the 60% of it, as well as the money management, which is 30%, would marry in and tie in very nicely, because we've got elements of emotion control and elements of the mathematics and calculation formulas that revolves around money and risk management would then intertwine and would then give the trader a better edge once he or she has actually covered that huge chunk of about a 90% that actually covers both money management and psychology. Okay, so here we would like to question about whether or not the element or the subject of just strategy would be the most important thing. In this case, I mean, it's laid out to you that it only comprises of 10%, okay, in relation to the others. So money management, it's quite a relative chunk that we would need to focus on, which is about 30%. All right, so we'll get into a couple of things here. I know that most traders would then talk about discipline and patience, and wanting to know about books that would then improve their discipline and patience in trading. But did you know that recent studies have actually shown that the activities of trading, if it does involve or revolve around the functionalities of the right and left hemisphere of the brain, would then encourage more discipline and patience, basically make the trader more disciplined and more patient if he or she engages between the right and the left brain much more. So you answer this question. If at all you've got a trader right in front of you who focuses almost 99.9% on the technical analysis, would it then be solely on one hemisphere of the brain, or would it actually be marrying both hemispheres together? Now, that's something for you to think about, traders, and this is quite a crucial element that has been out there by recent studies as well. Okay, so I want you to have a bit of a think on that, because this area of psychology and this area of understanding that you would be involving math and science, which is on the left side of the brain, would it actually then marry with other parts of the brain when you're actually trading? So that does actually involve in how you're managing your trades, whether you are actually involving money management elements of the trading side of things, like fundamental analysis, technical analysis. Do you have a balanced approach or not? So that would then mean that this is covering the entire functionality of the brain's hemisphere or activities. Okay, that's something quite interesting, I would guess. So this is something that we can cover much more into in the subject of psychology as well in our other webinars or topics of webinars that we would have available very soon. Now, I would like to also tell you a little bit about what syllabus would actually be covered. Now, one of the most important thing about the understanding in the subject of risk management is to differentiate between risk management versus money management. There may be a little bit of misconception about risk management being the same or similar to money management. There are probably some differences there. I'll get into that in the next slide, but before that I'd like to also give you a little bit of pointers, some crucial pointers that you would need to know about. It's the know-how, it's the must-know element before you incorporate both risk management and money management. And number one would be your equity. It is really important for you to have sufficient capitalization. Okay, it's also mentioned, has also been mentioned in the disclaimer section, whereby the excerpt says that do not trade with money you don't have. So have you actually allocated sufficient capital or equity for your trade, and are you willing to take that much of a risk following the equity that you have actually allocated? Okay, so that's number one. These are important elements that you would need to keep in mind and be aware of. Now, secondly, would be the broker's platform, in this case FXCC's trading conditions. Are you aware of margin requirement? What is margin requirement, and what exactly would be the percentages of margin call with the stop out levels? Are you understanding, do you as a trader understand these terms? I would say you guys should not be worried at all, because here at FXCC we have got all these videos to cover in detail and give you a simplified version of what they are, and with formulas and all that, which we will talk about at a later webinar. I mean at later webinar series. Okay, so apart from that, number three comes down to a sound strategy. Now, is your strategy sound enough or stable enough to incorporate all these risk and money management, or are you sufficiently covering the formulas into your strategy? Are you incorporating them? You know, does it actually make out a sound strategy that does actually have a risk management and money management formula, and the way you would organize your trade following it? Okay, so that's a very important thing. Now, the other thing as well is the question of time frame. You know, would it actually be married or connected to your equity? I mean, there are a lot of questions out there of whether or not I've got this much equity, I could then look into the daily chart. Now, does the weekly or daily chart be best fitted to a bigger sort of amount of equity or capitalization? So all these questions would actually be answered and laid out very simply for you in our series of webinar that comes under risk management and money management. Okay, so that's your fourth point on time management. The other thing as well is that, have you got a realistic enough personal goal of what you would like to achieve? Does that actually marry well with your equity, as well as a sound strategy in both your analysis side of things as well as your money management or risk management side of things as well? Okay, so these are elements that we would be covering in the series of webinars, and a couple of other very interesting topics will follow through. Okay, so I'll take you through the next sort of slide. Now, this one here, it's a sort of interesting illustration right here that talks about a bit of denial there, and I think we have heard a lot about traders having this in mind. They always would imagine or would like to cover their losses and imagine that they can actually cover losses. I mean, the thing about losses, covering losses as well, has got a lot to do, I would say, a major part of what would help control losses and help traders understand the risk appetite, and having it all incorporated would be a very sound risk and money management strategy. Okay, and one of the scenarios that would go very well with this whole scenario that I'm showing you on the slide would be a table here that would actually reflect on how traders majority are actually looking at their losses, or wondering or assuming, I would say, of whether or not they could be covering their losses. Now, one of the major misconception is very simply the amount of drawdown. Okay, so the amount of drawdown has got to do with the drop of equity level or your capital level. And when that drop actually occurs, let's say if you've got a client, or sorry, if you've got a trader who have actually lost about 10% of their equity. Now, if you ask the question to this particular trader, how much more would you need to cover up? And it's very simply said that they would be covering up that exact 10%. Now, if you look into the required return to repair the drawdown, it's a total different story. Now, this is where, if, for example, let's look into the midway section of 50%, if a client have actually lost about 50+%, the required return would be about 100%, not that 50%, okay? Because that would actually mean that the client needs to cover a larger amount only because he's got less amount of capital to work on at that moment of time. All right, so you could look into all the following numbers in terms of percentages as well. Loss of capital equals to, you know, roughly the required return to repair that drawdown. So all these sort of misconception could be well repaired, I would imagine, if you have got, you as a trader would have a sound risk and money management strategy, which we at FXCC would be very happy in looking into providing all these videos and webinars that will cover exact topics as well as formulas. Okay, let's go on to the differentiation of the term risk management, between risk management and money management. We'll start off with the risk management side of things first, and there's this quote or saying by Warren Buffett right here, which says that risk comes from not knowing what you're doing. So let's get into that. A little bit about risk management first in terms of definition. It usually answers the question of the percentage of equity to be a risk, you know, your risk appetite or risk tolerance. So managing one's risk is directly related to the risk tolerance that I've talked about, which is also known as risk appetite. So in order to manage your risk better, you would need to be aware of the impact that it has on the trades, okay, as well as the remaining equity of your account. So this is this has got a lot of connection to the term of conditions of margin calls, as well as being stop out. You probably have heard as a trader the stop out level and the margin call level, and these are easily checked on your FXCC trading conditions as well, so you get a better idea on how to insert the right formulas by knowing the levels of your trading conditions. Okay, especially when it comes to margin call and stop out levels. So let's just look into the next slide here. There are other elements that is quite important for the area of risk management to be understood, especially capitalization that I've mentioned earlier on. Do you have, that answers the question of whether you do have sufficient capital or not, as well as the position sizing, which means the number of trade positions you should rightfully open at a time that actually does have a very strong connection with the equity and your risk appetite. And finally, the drawdowns level. So as you can see, risk management side of thing has got a lot to do with the money management elements, okay, and vice versa. So let's get into the next slide here that comes under money management, and there's another very interesting saying. This time it's by Robert Kiyosaki, and he says that if you don't know how to care for money, money will stay away from you. Okay, so that's quite an interesting one. So money management itself, by definition, answers the question of lot sizing as well. Now that is quite a big topic there on lot sizing, which will be covered in our series of webinars under the topic of lot sizing itself. So there's quite a lot of elements or subject formulas as well to look into it, but simplified formulas that could actually help you understand the application of lot sizing onto your trade. So very easily, how big a lot size you are supposed to open per time of trading? That would be a very crucial question to answer, okay, in this area of money management. Now, money management, to properly manage your money, you would need a system or formula that would enable you to decide your lot sizes, as we've mentioned earlier on. So in other words, it's about how many lots to trade, how many lots to trade for every single trade you're thinking of executing. So this has got a lot to do with taking the emotions out of trading element, okay, so as well as reducing your risk and your risky intentions, and using instincts or gut feeling or sixth senses or whatever you may call it to make financial decisions. So that would then help cut that side out. Okay, so let's just look into some other core topics that revolves around money management. And as I've mentioned earlier on about risk management, money management very similarly has got its connection with risk relations. Okay, as I've put that on brackets. Now, in terms of topics, we've got managing losing trades, stop losses, and as well as the question of whether it matches with your strategy. Okay, a very important part. So these are elements or subtopics that would actually be discussed in detail, presented to you in the series of webinars. All right, there we go. There are a couple of things to also inform you about important elements that will be covered in the next series of webinars, and that does actually include very clearly these three elements: margin requirements, margin call, and stop-up level. In the next webinars, you would be getting a clearer picture of what margin requirements are, what is the margin call or stop-up level, and what are simple ways of how we could insert important levels and numbers that you could easily get from your brokers platform, which is FXCC's trading conditions section, and fill up the formulas as you can actually see. So here I would like to just share with you on the FXCC's brokers platform, especially on the trading conditions section, that would give you a very nice break through of the main features that concerns leverage, margin call level, as well as stop-up level, depending on the type of account, whether it's an ECN XL account, ECN standard account, or the ECN advanced account. As you can see there, we've got a small descriptions as well in there. Now, do not worry, as traders, who are going to be attending the series of webinars under money management and risk management, you will be given, you will be presented with the rightful webinars that would explain these topics in detail. So I would like to welcome you to the next webinar, and we'll see you there. Again, thank you very much for listening, and we'll see you at the next webinar. Bye-bye.